Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data. Because while retail investors have been watching red candles, panicking over whale transfers to Coinbase, and reading headlines about Clarity Act delays, something happened in the institutional market last week that most of the XRP community has not processed with the analytical weight it deserves. According to the latest CoinShares weekly fund flow report dated April 14, 2026, XRP investment products recorded $119.60 million in weekly net inflows, the strongest single week since December 2025, representing 53% of all global crypto fund inflows across every digital asset in existence during that period. Not Bitcoin, not the entire altcoin market combined. XRP alone captured 53% of global crypto institutional fund flows in a single week, while retail was distracted by a temporary price dip and a whale transfer that generated fear without generating understanding. The 89.8 million XRP transfer to Coinbase that caused retail panic was not a distribution event, it was a liquidity positioning move. And the $119.60 million that flowed into XRP investment products during the same window is the institutional community's documented response to exactly that kind of retail sentiment deterioration. Stay with this analysis through to the end, because I am going to walk through Standard Chartered's precise mathematical framework for the $5 to $10 price target and explain exactly why the end of May deadline that Brad Garlinghouse confirmed at the Semafor World Economy Summit is not a delay, it is the final compression before the most significant regulatory catalyst in XRP's history. Let us establish the precise significance of the $119.60 million inflow figure before we address the Garlinghouse statement. Because the CoinShares data requires analytical context that transforms it from an impressive number into a structural signal about where institutional conviction actually sits in the current market. CoinShares tracks professionally managed investment products, ETFs, exchange-traded products, and institutionally accessible funds, rather than retail on-chain activity or exchange trading volumes. When CoinShares reports $119.60 million in net inflows to XRP products, they are reporting the aggregate of capital deployment decisions made by registered investment advisors, asset management firms, hedge funds, and institutional treasury operations. They went through formal compliance review and investment committee approval before executing. These are not retail investors buying XRP on Coinbase because a YouTuber told them to. These are professional capital allocators making documented fiduciary standard decisions that 53% of all global crypto institutional capital should flow into XRP products in a single week. At a moment when the retail sentiment environment was characterized by Clarity Act delay headlines, whale transfer panic, and price consolidation frustration, the institutional community was executing its largest single-week XRP allocation since December 2025. That divergence between retail sentiment and institutional action is the most important data relationship in the current market, and the $119.60 million figure is its most precise quantitative expression. The 89.8 million XRP transfer to Coinbase that generated retail panic deserves a precise analytical treatment because the misinterpretation of that transaction is the specific event that created the retail selling opportunity that institutional capital absorbed through the $119.60 million inflow. Whale alert tracking a large XRP transfer to a centralized exchange generates an immediate retail interpretation. A large holder is preparing to sell, which means downward price pressure is coming, which means retail should either sell ahead of the anticipated pressure or at minimum reduce exposure. And it is the interpretation that the $119.60 million in institutional inflows directly contradicts. Large institutional holders move XRP to centralized exchanges for multiple reasons that have nothing to do with distribution. ODL corridor liquidity positioning, ETF rebalancing operations, institutional custody transfers, and collateral management all generate exchange inflows without representing selling intent. The retail community's inability to distinguish between these different transfer motivations is the specific analytical gap that allows the institutional accumulation dynamic to operate at the scale the CoinShares data documents. Because every retail seller responding to whale transfer panic is providing supply to the institutional buyers executing the $119.60 million allocation at prices that the institutional community considers below fair value. I want to address Brad Garlinghouse's statement at the Semafor World Economy Summit with the precise analytical framing it requires, because the retail interpretation of his Clarity Act timeline update that end of May represents a delay, and therefore a negative development is the opposite of what the statement actually communicates to anyone reading it with institutional analytical standards. Garlinghouse said at a summit attended by the most sophisticated macro finance minds in the world that when people are at their peak frustration, that is when they finally compromise and get it done. And he stated directly that he believes we are there. That statement is not a CEO managing expectations about a delay. It is a CEO who is in direct communication with the senators, the banking lobby representatives, and the White House policy advisors involved in the Clarity Act negotiations, communicating to a sophisticated audience that the legislative compromise conditions have been met. Peak frustration in legislative negotiations is not a sign that a bill is failing. It is the specific condition that produces the compromise agreements that allow contested legislation to advance. Every significant piece of financial legislation in recent American history, Dodd-Frank, the Jobs Act, the Bank Secrecy Act amendments, reached its final passage after a period of peak frustration among the negotiating parties that forced the compromises required for a majority vote. Garlinghouse is telling you that XRP's most important legislative catalyst is in that phase right now. That is not a delay. That is a countdown. The Clarity Act's significance for XRP extends well beyond the regulatory cleanup of the SEC lawsuit resolution, and Garlinghouse's characterization of it as far bigger than anything Ripple itself could do alone is the statement that most retail commentary is not unpacking with sufficient precision. The distinction Garlinghouse is drawing is between Ripple's individual corporate regulatory relationships and the systemic transformation that the Clarity Act would create for every financial institution in the United States simultaneously. When the Clarity Act grants XRP permanent digital commodity status under the CFTC, it is not simply confirming what the courts already established through the SEC lawsuit resolution. It is creating a federal legislative framework that allows every nationally chartered bank, every federally regulated investment advisor, every insurance company, every pension fund, and every sovereign wealth fund operating under U.S. regulatory oversight to treat XRP as a commodity, the same regulatory category as gold, oil, and agricultural contracts, for all purposes of portfolio allocation, collateral management, balance sheet treatment, and cross-border liquidity deployment. The institutional adoption that follows a commodity classification at the legislative level is categorically different from the institutional adoption that follows a judicial ruling, because legislative classification creates the compliance certainty that investment mandates require, and judicial rulings, however favorable, cannot provide with the same permanence and breadth. The standard chartered price target framework deserves the detailed mathematical engagement that most retail commentary provides only superficially, because Geoffrey Kendrick's institutional research methodology is not producing these targets through sentiment analysis or technical pattern matching. It is producing them through capital flow modeling that connects specific regulatory trigger events to specific institutional demand responses and then calculates the price level at which the resulting supply-demand equilibrium stabilizes. The $8 end of 2026 target is conditional on the Clarity Act passing and generating $4 billion to $8 billion in additional ETF inflows from the institutional allocators whose mandates require legislative commodity classification before authorizing full digital asset allocation. At XRP's current market capitalization of approximately $86 billion, adding $4 billion to $8 billion in institutional inflows into a supply structure where whale accumulation, ETF custody growth, and ODL corridor positioning have been systematically compressing available liquid supply, produces a price impact that Standard Chartered's liquidity modeling maps to the $8 range. The $10 target, which implies a market capitalization of approximately $610 billion, represents the scenario where the institutional inflow from Clarity Act passage is accompanied by the utility demand acceleration from full U.S. domestic ODL deployment, the continued Mohaloop cross-border routing expansion, and the secondary capital rotation from altcoin holders who redirect capital into the highest conviction utility-grade digital asset once regulatory clarity removes the compliance barriers that have been limiting institutional commitment. A $610 billion market cap for XRP would place it at a level comparable to Ethereum's peak capitalization. And Ethereum reached that peak without the cross-border payment utility, the Gates Foundation infrastructure deployment, or the sovereign financial institution partnerships that XRP has been building for the past decade. The window that Garlinghouse's end of May timeline creates is the specific temporal constraint that institutional capital is already responding to, and the $119.60 million weekly inflow that CoinShares documented is the most direct evidence that front-running of this catalyst is already underway at scale. Front-running a known catalyst in institutional finance is not the same as insider trading. It is the standard practice of positioning ahead of a publicly known regulatory event based on a professional assessment of its probability and its expected market impact. The Clarity Act markup is a publicly known event with a publicly known timeline. The institutional analysts at Standard Chartered, Bitwise, Franklin Templeton, and Canary Capital have all published their assessments of what Clarity Act passage means for XRP's price. The capital that has been flowing into XRP products at a rate of $119.60 million in a single week is front-running the end of May catalyst based on those publicly available institutional assessments. The retail investors who are watching red candles and panicking over whale transfers are not front-running anything. They are providing the exit liquidity that allows institutional front-runners to build their positions at suppressed prices before the catalyst event reprices the market to reflect the new institutional demand environment that Clarity Act passage creates. The mathematical relationship between the Clarity Act's commodity classification and XRP's required price at full institutional deployment scale is the analysis that connects the Standard Chartered $8 to $10 target to the operational reality of what XRP is being positioned to do within the global financial system. A commodity classification under the CFTC does not just unlock ETF inflows, it unlocks the full spectrum of institutional financial applications for which commodity classified assets are eligible. Derivatives markets can list XRP-linked instruments without SEC oversight constraints. Banks can hold XRP as collateral in lending operations without triggering securities regulation risk-weighting requirements. Corporate treasuries can allocate to XRP for liquidity management without requiring securities law compliance infrastructure. The aggregate demand from all of these institutional application categories simultaneously becoming accessible after a single legislative event is what Standard Chartered's $4 billion to $8 billion inflow projection attempts to capture, and that projection covers only the directly measurable ETF channel, not the broader institutional adoption that commodity classification enables through derivatives, bank balance sheet treatment, and corporate treasury allocation. When you add the utility demand from full U.S. domestic ODL deployment, which requires no Clarity Act to proceed, but is currently constrained by the institutional caution that legislative uncertainty creates, the total demand acceleration that end of May could trigger is a figure that makes the $8 to $10 price target look conservative rather than optimistic. The specific language Garlinghouse used at the Semafor Summit, that the Clarity Act is far bigger than anything Ripple itself could do alone, provides the institutional scale context that retail investors need to understand why the end of May timeline represents an urgency that the current price does not reflect. Ripple as a corporation has spent a decade building bilateral relationships with individual financial institutions, obtaining jurisdiction-specific regulatory approvals, and deploying ODL infrastructure through agreements that require each institution to make its own compliance assessment independently. That bilateral relationship-building process is inherently slow, resource-intensive, and limited in scale by the number of institutions that Ripple's business development team can engage simultaneously. The Clarity Act replaces every individual bilateral compliance assessment with a single federal legislative framework that every U.S. regulated institution can rely on without conducting its own independent legal analysis. The scale difference between bilateral relationship building and federal legislative clarity is the difference between linear and exponential adoption curves, and Garlinghouse's statement is acknowledging precisely that distinction. When the Clarity Act passes, Ripple does not need to convince each bank individually that XRP is safe to use under their regulatory framework. Every bank in America receives that assurance simultaneously from the federal legislative record. That is why the end of May is not a delay. It is the catalyst that transforms XRP's institutional adoption from a bilateral relationship story into a systemic infrastructure story. The complete analytical picture that April 28th's data assembles for the positioned investor is one that should be producing clarity rather than anxiety about the end of May timeline. The $119.60 million single-week institutional inflow represents 53% of all global crypto fund flows.
Smart money is front-running the May catalyst at maximum pace, while retail is distracted by temporary price consolidation and whale transfer misinterpretation. Brad Garlinghouse, speaking to the most sophisticated financial audience in the world at the Semafor World Economy Summit, communicated that the legislative negotiation has reached the peak frustration phase that historically precedes final compromise and passage. Standard Chartered's Geoffrey Kendrick has published an $8 end of 2026 target conditional on $4 billion to $8 billion in post-passage ETF inflows, a target that would require a $610 billion market cap at the $10 level, comparable to Ethereum's peak capitalization, but supported by a utility deployment record that Ethereum's peak never had. The Clarity Act commodity classification unlocks not just ETF inflows, but the full spectrum of institutional financial applications: derivatives, bank collateral, corporate treasury, sovereign fund allocation,
simultaneously through a single federal legislative event. And the window before that event, based on Garlinghouse's public confirmation of the end of May timeline, is measured in weeks rather than months. The retail investors watching daily candles and panicking over whale transfers are providing the supply. The institutional capital recording $119.60 million weekly inflows is absorbing it. The question is which side of that transaction you are on when the Clarity Act passes. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.